Welcome back for a dose of alpha. Today we got Kory Hoang with us from Stably. Kory, welcome.
Hey guys, how you doing?
Today we have a little dose of alpha.
This isn't going to be the average DeFi podcast.
We're going deep.
I think a lot of eyes were opened.
I mean, we're recording right now. I just traded $6 billion this morning.
Well, now things are driving towards business.
Wow, we're printing money. You excited for that?
You know, the U.S. Treasury prints physical cash and money. The Federal Reserve creates central bank reserve, not a type of money, right? But it's all part of what's called M0, monetary base. We start with M0, which is considered physical cash or central bank reserve. This is the base money supply, right?
So Kory, we've worked with you for a long time. We love working with you. Brilliant dude. But for people who are probably hearing about you or from you for the first time, who are you? What's Stably? What's your role in this ecosystem?
Sure. Yeah. Happy to give a little bit of an intro. So I'm Kory. I'm the CEO and co-founder of Stably. Stably's been around since 2018. We are a stablecoin technology and advisory firm based here in Seattle. We were the fifth US dollar stablecoin issue in the world back in 2018. Fifth one listed on Binance as well. But we pivoted to stablecoin infrastructure development, stablecoin-as-a-service, and advisory ever since late 2019. We've been doing that ever since. We've helped launch many stablecoins, probably supported launching over 20 plus stablecoins at this point for ourselves, clients, partners throughout the years. And today we work with financial institutions, businesses, helping them explore the stablecoin space, trying to figure out how to integrate stablecoins into their ecosystem, or perhaps even exploring launching their own branded stablecoin to integrate within their ecosystem, or even expanding outside their ecosystem. So yeah, that's pretty much us in a nutshell.
2018 is early to start doing stablecoin stuff. What brought you to stablecoin infrastructure? What was the process like? What's your background? How did you end up where you are?
It was, I guess, kind of logical because I was working in finance right before this. I was an analyst at PitchBook, and I was analyzing, private equity, venture capital data as part of my role there. And on the side, I was also engaged in a lot of algorithmic trading, just personal hobby, not professionally or anything. But one of the things that I used to trade back then very actively used to be VIX derivatives. If you're familiar with what those are, I used to short VIX very, very aggressively back during the low interest rate era when volatility was very low. And so I went to these algorithmic trading meetup in Seattle, and that's how I met my co-founder and my CTO now, David. And we were sharing volatility trading strategies together, and came to find out he had a lot of similar strategy as mine. So we clicked right away, and we became very good friends. And so fast forward to I think 2017, we met in 2016. Fast forward to 2017, I was working at PitchBook. He was an engineer at Amazon, and we started noticing that our volatility trading algos somehow it also apply very well to crypto. I guess, trading volatility is kind of like pixie dust. And then, crypto back then was also kind of like pixie dust, right? so it was, so we took some of the very basic trend following strategy that we had and apply it to Bitcoin, Ethereum, Litecoin back in the day. And 2017, I'm pretty sure it was the market as well. It wasn't just our algo. 2017, as you guys remember, market took off. And so we made a little bit of money that year. But we, while the whole time we were trading crypto with our, algo or even manually that year, we, the only stable coin really that was available was USDT. And immediately we realized that, this was going to be a next evolution of digital money, right? Where you can have decentralized or permissionless openly transfer digital asset that represent, a dollar equivalent, right? That could be used as a medium of exchange or for settlement or, for trading purposes. and there should be more than just one, right? Having just one, early back in the day, one is, good to start, but then you need to diversify, and, there needs to be more entrants into the space, right? So it was a very natural, kind of like, thing for us to realize, an opportunity that we realized. And so,
all right, hold on a second. You're like 2017, 2018, you're like, we're going to go take on Tether and we're going to go take on USDC Circle. Like what, like talk about that for a second. Like, did anybody come to you and say like, that is nuts? Like, that's just like absolutely insane.
I mean, it's insane now in hindsight, looking back, but back then Circle wasn't even out yet. This is 2017 we're talking about, right? I was trading on, these random crypto exchanges, and you had to get Tether into them. You had to get USDT into them, right? You couldn't get Fiat into them. And so, but, it was the only one around, right? There needs to be more than one. That was it, right? There has to be more than one provider in the space.
When did Tether launch on these centralized exchanges? Was Tether on?
Oh, I mean, as soon as I came into, well, I've been trading crypto ever since like 2013, very unsuccessfully, by the way. But, when 2016, when I started doing it very heavily again, it was, Tether was already pretty prevalent in like, not everywhere, but, it was showing up in a lot of exchanges already. And, I mean, some of the exchanges I use, it's not even around anymore, right? But they started taking in USDT back in the day. There was no fiat on and off ramp other than USDT, right? I don't even know how I bought my first USDT. Oh, actually, off of a friend, and we just like OTC it, right? So that was pretty much the only way, right? And so, but there needed to be more than one, right? There can't just be one stable coin out there, right? There has to be more than one, and there was a huge space. And so if stable coin were going to eventually replace, well, maybe not replace, but complement the existence of cash or like traditional digital money, then this is going to be a very big opportunity. And so, by the end of 2017, my David and I, we decided to leave our job. I left PitchBook. He left Amazon, and we started fundraising a small seed round for Stably, right? We put together a $500,000 seed round in early 2018, and off to the races we go. We start working on our first stable coin called USDS, Stably USD, and we got it up and running by the end of 2018. Got it listed on Bittrex, and by early 2019. Managed to get it listed on Binance as well. We were the fifth US dollar stablecoin listed on Binance. Yeah, and then we raised some a little bit more funding, not too much. I think like another $1 million in 2019 to keep growing the company. But in 2019, we once we got onto Binance, right? As you said, Bryan, like before. What were you thinking, right? Why are you going up and fighting all these giants? Well, I had no idea, right? So when we got into Binance, we realized that there was a stablecoin war ongoing at that point. Now, there was already very, a little bit after 2017, right? 2017, USDT was the only one around. By early 2019, when we got USDS onto Binance, there was already USDC, there was already Paxos, there was TUSD on Binance as well. And outside of Binance, there were a few other stablecoin like Gemini, right? And so there was a stablecoin war ongoing. The first stablecoin war, from 2019, that I actually wasn't aware of. It wasn't until we got into Binance that we felt the effect of it. One of the things was, as you know, when all these new stablecoin came out, everybody saw the same thing that Stably saw, right? Everybody saw that stablecoin was going to be the future. And so, a lot of companies raised a lot of capital, way more capital than we did, and went into the market and tried to effectively buy up as much market share as they can, right? One of the things that they did is they worked with market makers and OTC desks and institutional traders in order to provide liquidity for their stablecoin on central exchanges such as Binance or Bittrex or OKEX. And back in the day, this was before DeFi, right? This was before decentralized exchanges and protocols and all that. So, centralized crypto exchanges was pretty much the ecosystem, right? And so you had to have, as a stablecoin company, you need to have like major presence and liquidity support, and and a lot of market makers partnerships and all that, right? So um, and when all these companies did, from Circle to Paxos, uh, I'm not sure if all of them did it, but I know for sure like some of them did it, right? They actually sold their stablecoin to market makers and OTC desks at a discount, at a slight discount. So they would sell it at like 99 cents or 98 cents on a dollar, and they would require these market makers and liquidity providers to lock up the stablecoin without being able to redeem them for a specific period, right? Depending on how large the discount is, right? The larger the discount, the longer the lockup you have to hold, right? And so you can't redeem them in time. So the market makers at that point, they are effectively forced to go out and redistribute, right, that stable coin which they bought at the discount by simply selling it, right? Selling it either for Bitcoin or like another stable coin, for example. Now, if they can manage to sell, the stable coin that they bought at a discount, swap it for another one at basically near one-to-one, right, on the exchange, they just realize that, discount as a profit without having to even redeem, right? And now what they can do is they can simply redeem the other stablecoin that they swap into. So that's what we felt when we got onto Binance, because we were the other stablecoin that people were swapping into, right? We were a small project, we didn't have a lot of funding or money, right? So I can't afford to, give market makers a lot of, discount, or any discount for that matter, right? We just couldn't afford it, But when we learned that the market makers were getting these deals from, the big stablecoin issuers, that's when we realized, oh, okay, well, that explained why, people kept going in redeeming our stable coins, and that makes sense now. But that's also the same moment I realized that what have I gotten myself into? Because it was literally, it's a liquidity war. The stablecoin war is a liquidity war, right? So unless, from my side, unless I'm able to raise significant amount of capital in order to match that, incentive, those incentive program, and also, get a lot of liquidity to come in and, compete against these players, then it's going to be very difficult, right? Especially when everything was just centralized on these, centralized exchanges, right? Very quickly, we realized that we need to do something different. By early 2020, right before COVID started breaking out, we actually decided to delist from Binance and pivot stably from running our own stablecoin brand to doing stablecoin-as-a-service. We were one of the earliest stablecoin-as-a-service pioneer in the world, actually. I think probably the second one after Paxos. Paxos was the first one. They white labeled the BUSD, Binance USD stablecoin back in the day, if you recall. And then, we came out and we started doing very similar thing. We took the infrastructure and expertise that we already developed, and we started working with many institutional or enterprise or blockchain clients in order to help them launch their own stablecoins, right? Early on, the space was very early, not a lot of interest, basically, right? Because the only ones who actually needed stablecoin infrastructure back in the day were blockchain foundations, or, emerging blockchains, should I say, right? Kind of like emerging markets. These emerging blockchains, they lack fiat on and off ramp and stable infrastructure, and so that's why they reach out to us, right? And back in the day, this was before like bridging infrastructure and on and off ramp infrastructure was more prevalent. And so stably, we work with many clients such as Stellar, Tezos, VeChain, Harmony, XRP Ledger back in the day, right? The list goes on and on.
That's an awesome set of clients you have there. Okay, so now we got the stablecoin infrastructure, the rails out there. Why do you think crypto, and why now? What's got you excited?
Why now, huh? Well, I mean, it's always been exciting. I think it's even more exciting now that AI is coming out, and no, it's still very early, right? A lot of people are hyping up, agentic economies and AI-driven transactions, which is super cool, super exciting. I'm not here to downplay, that the opportunity and importance of that, right? But I do have to acknowledge it's very early. As excited as I like to get about it, it is very early, but the potential is immense, right? Like, you think about humans making transactions with stablecoin and you think that's cool. Imagine until, wait until the AI start, using stablecoins at scale for, on-chain, economic transaction or autonomous transaction among themselves, whether it's machine to consumer, machine to business, or machine to machine, right? Like, it's a whole new categories of financial or like transaction that could happen. So that's
Is that
what
why you?
I can't even like begin to like explain all the things that's on my head about it. I'm just too hype about it, so maybe we can just keep that.
Is that why you got into the recent report that you put out, the recent publication? Start to like frame the problem, frame the situation.
Yeah, I mean, part of it, part of the issue was, yes, in the future, as more and more stable coins come out and as AI adoption continues to increase, more AI agents and applications will start using stablecoin, perhaps issuing their own stablecoin too. Who knows, right? Before we even get there, right? The industry right now by itself, it needs to like fully understand what kind of stablecoins can you create, right? I mean, we've evolved a lot since 2017 when I first started, talking about stablecoins, right? Back then it was all fiat-backed stablecoin. It was just USDT, right?
Yeah, now we've
Now,
got yield-bearing stable coins. We've got different debt issuance. We've got, this is a stable coin backed by private credit, and everything has different redemption liquidation policies. Stablecoin is a really, really broad term now. We got stable coins without pegs, which gets weird. So it's definitely changed a lot. One of the humorous to me is like with crypto going down in major bear markets, like, hey, you guys built all of this crazy infrastructure, but you're, hoping to get billions of users and nobody's coming. And then Claude comes out, and now all of a sudden we've got billions of users, trillions of users lining up. So a lot of the, where's this traffic gonna come from? That was answered by AI coming out. So now it's how do they get activated? What tech stack wins? And a lot of that needs good stablecoin infrastructure if that's how payments are going to be handled.
with the AI thing, again, I think it's still very early, right? But to your point, I think one day when the agentic economy evolves a little bit more, AI agents using stablecoin as, a natural, medium of exchange for transactional purposes is a no-brainer. Stablecoins weren't made for humans. It's made for the machines. It's made for the AIs, right? That's what I'm really starting to like, shifting my mental model toward, right? After working in this whole industry for like almost 8 years now, or more than 8 years now, I'm finally starting to realize that first 8 year was just boot camp because now the future is really how do we build this better financial transaction, not just for the human but now also for the machine, which are emerging, right? As early as it might be, is exciting, right? And that's what keeps me up at night, right? I think a lot about this stuff.
So with your awesome paper, by the way, really love reading it. Deep dove, took notes and everything. With this new paper on like a proposed taxonomy around stablecoins, can you break down for the audience like what is like M0 through M4 in traditional finance, and then how do you generically classify new stablecoins under this framework?
Yeah, I guess yeah. So for some context, so I wrote this stablecoin taxonomy and money supply research report. The inspiration for writing this was because, first of all, the existing classification framework that we have, there's no formal one, right, for stablecoins. The very early models that the industry has been using since 2017 or like 2016, right? It was revolving around the stablecoin trilemma, as you recall, right? The whether a stablecoin is fiat-backed, crypto-backed, or algorithmic, right? And I mean, it was a fine model back in the day, right? But now we are, the industry has evolved a lot. We don't have just like those specific type of stablecoins anymore, right? We have many different flavors out there, and these flavors are also mixing with each other to make newer flavors, right? That's the nature of DeFi composabilities. So we need a better, the previous model, it was a bottom up approach, right? Where you look at like what kind of collateral is backing, right, the stable coins, and then you put some sort of surface level labels on them, like crypto back or algorithmic back, blah blah blah. I think it's better to do it with a top down approach, right, where top down taxonomy, where you still look at the collateral, right, but from a top down perspective, right, not going right away to whether this is fiat back or crypto back or not back at all. Let's start with whether it's exogenous collateral, or the stablecoin is exogenously backed, or whether is it endogenously backed, right? Exogenous mean is backed by external assets, and then endogenous mean it's backed by something that within itself that it creates, right? A lot of people say that might be nothing, right? But
like Terra Luna.
that's one example, or the US dollar, which is also endogenously created, right? So you can't say that it's backed by nothing. It's backed by something, right? Just not external assets or reserve or collateral, right? So let's start there, exogenous and endogenous, right? Now, within the exogenous bucket, you have many other subcategories. You have reserve-backed stablecoin, right? And then you have the crypto-backed, or the CDP, collateralized debt position-backed stablecoin, right? Which is very prevalent. And now, more recently, you start having strategy-backed stablecoin, right? Or I call them SBS. And these strategy-backed stablecoin, they're similar to reserve-backed stablecoin, right? They're backed by a pool of capital on a one-on-one basis, or minimally at a one-on-one basis. But reserve-backed stablecoin usually have a static pool of reserve assets that are liquid, high quality, whereas strategy is more speculative, could be, requires more hedging and more risk management, right? It's not the same as most typical reserve-backed stablecoins. So those are the three categories that you have under exogenous, right? The reserve-backed, the RBS, the CDP, and the strategy-backed stablecoin. What these different elements can actually be combined together to create hybrids, right? You can actually create a hybrid between a reserve-backed stablecoin and a CDP stablecoin. And guess what? The largest decentralized stablecoin in the world right now is in fact a hybrid, USDS from Sky. Well, fun story on that, by the way. So USDS was our original ticker for Stably. We actually sold that to Sky, I think around in 2024. So it found a new home. USDS, the ticker, found a new home at Sky, and now it's the largest, decentralized stablecoin in the world. It's amazing, right? But yeah, USDS is a hybrid stablecoin that is issued by Sky Protocol, formerly MakerDAO, and it is backed by both a pool of reserve assets and also collateralized debt position. But back in the day, it wasn't like this, right? Back in the day, it was purely a CDP, but then over time, the project evolved and now it has become a hybrid. Many projects in this space has also done that. They kind of, unless you're a regulated centralized stablecoin, right, which means you're just vanilla, right?
If you're not growing, you're dying. So
well, there's that, and but if you're just a centralized vanilla stablecoin, there's nothing wrong with that, right? I mean, those are regulated, and they're becoming very mainstream. They're the largest category in the whole world, right? Like I think more than 90% of stablecoin in the world are fiat backed. But the other, 9 to 10% that is not fiat backed, over time, I think that category, it will, grow in market share as well. And you will see a lot more innovations coming out, a lot more, blending of different elements, designs in this category here, right? And all of those.
Yeah. With something like Sky, there's a little bit of a hybrid model. It's not just like a one-to-one reserve. They're getting a little bit more composable. They're putting on their risk frameworks, doing the strategy back plus the CDP. It's really amazing. What I'm really curious about, and the thing that kind of like keeps on dripping in my head, is that there's kind of like this like inverse thing in your paper that like I tapped into. The dynamic was in around like traditional fiat. When you're lending money and there's a credit expansion, it tends to increase the total money supply. However, it seems to be with these strategy tokens and these reserve-backed stablecoins, credit expansion actually reduces money supply. Can you walk through that a little bit?
Yeah, for sure. So now we're going to the money supply aspect of the report that I wrote. So not just taxonomy anymore, right? So as far as for context, right? Well, let's understand what is the money supply for the fiat system, right? How is money even created in the traditional economy in the fiat world, right? So in fact, how is money created in the fiat world? Most people don't know the answer to this question, right? They think the Federal Reserve prints money. Well, the U.S. Treasury prints physical cash and money, the Federal Reserve creates central bank reserve, another type of money, right? But it's all part of what's called M0, monetary base, right? So we start with M0, which is considered physical cash or central bank reserve. This is the base money supply, right? From this base money supply, additional money could be created through loans, right? This is where you hear the phrase where in our economy, money is created from debt. So what does that mean? First of all, when the US government, the US Treasury, and the Federal Reserve, which is technically not part of the US government, right? It's an independent branch, right? When they create money, it's created endogenously, meaning it just created out of thin air, right? Base money created out of thin air. Back in the day, it used to be backed by gold or whatever, but post 1971 and Nixon shock, it's not the case anymore, right? So now the central banks, the Fed, right, just creates money out of thin air, central banks reserve out of thin air, and they deposit these central banks reserve into the bank account of commercial banks, which are held at the Fed, right? So after that has been created, right, now the commercial bank are allowed to do what's called commercial bank money creation, right, via credit creation. So now commercial banks can actually just extend loan, right? They can just extend loans to you, give you a loan to buy a house or, to buy a car, whatever, right? But before, when they give you the loan, what do they have to do? They have to deposit the money into your account, right? That's why money in your bank account, those are called deposit liabilities, right? Because, they're technically created from loans. And so these, and it's a liability to the banks, right? And the loans that the bank created becomes an asset to them effectively, right? So banks, commercial banks also create bank money out of thin air. They drop it into your account to loan it to you, right? And then you use that money in order to buy a house or buy something. And that property there, that real hard physical asset there now becomes collateral to secure that loan, right? So it's what's called ex post collateralization, right? You create the loan, you create money first, and then you take the money, you go get the collateral, you go get the house, right? Now the house becomes the collateral to secure the loan. Whereas for CDP stablecoin, it's ex ante, right? Meaning you have to put in the collateral first, and then the CDP also creates stablecoin money out of thin air and then give it to you. So CDP stablecoins are actually very similar to the fiat system, but it's flip around, right? Now back to the fiat system, right? So when banks create money out of thin air and they loan it to you, right, it increases the money supply, right? It increases the money supply because that dollar that's not going to get lent to you, you're going to go take that and you'll spend it. That's going to get sent to someone. They deposit into another bank. That other bank now have more deposit liabilities, and then the previous bank have to settle reserve over there to the new bank. It's a whole, and then that new bank can now extend more loans, and then those loans go back into this other system, and then it just the money multiplier effect. That's what it's called, right? When banks can just create money out in there in order to give out loans and increase the money supply, right? That's the fiat system that we have. In fact, nowadays, banks just create, loans first. They go get the reserve after. They don't even need the reserve first anymore, right? Banks literally give out loans first, right? And then, when, they actually need reserve, they can, either sell the loan to the Fed, get reserve, or they can pledge the loan as collateral and borrow reserve from the Fed, right? Until more reserve from other banks get settled to them. So that's the way that the system works in the fiat world. Credit creation and money creation is the same thing. It's literally the same thing. And that's why, more debt, more credit means more money supply, right? In the economy. It's not the same for stable coins. For at least for reserve-backed stablecoin, right, which is the largest category.
So real simply, great deep dive into traditional finance and how the banking system works. Can you break down for the audience, what is M0, what is M1 when it existed, what is M2, all the way up to M4? So they can understand the classifications.
Yeah, sorry, I forgot about. So M0, as I mentioned earlier, the monetary base, right? Physical cash that the U.S. Treasury mints, or central banks reserve that the Federal Reserve creates, endogenously. That base money allows banks to create loans. And these loans, when they deposit it into your bank account, right, they become deposit liabilities. That's called M1 money. the M1 money supply. And that is basically called narrow money, right? Narrow money meaning it's very spendable. It's like very transactional, right? Very liquid. You can withdraw it. They put the loan into your bank account. You can withdraw, you spend it, you do whatever you want, right? You send it to another person. That person have it in their account. They can withdraw it, they can spend it.
And would this be what we use for like Venmo or ACH?
Yeah, so bank deposit, specifically bank account, right? I mean, Venmo and fintech apps and everything like that, it all operates on, banking system underneath, right? So, basically transactional money. M2 money supply is when, it's still the same fiat money, but now it's a little bit less liquid. It might be sitting in a term deposit, or it might be sitting in a retail money market fund or something like that. And so it's still basically cash or, equivalent, but they're a little bit less liquid than narrow money. That's why they're called near money. They're near liquid, right? But they're not narrowly liquid. So the M2 money supply, M2 is actually consists of M1 is M0 plus loans, basically, right? Deposit liabilities. And M2 is M1 plus money that's sitting in these term deposits and, retail money market funds and so on, right? So, the base money supply, the M0 is probably like, I think 5 or 6 trillion, something like that. But the whole entire M2 money supply, including M1 is, I think, above $20 trillion or something like that, right? I have to double check my numbers. Might be,
That's massive. That's a massive difference.
Yeah, it's huge, right? Because, credit creation is money creation, right? And so that difference there is basically created through debt issuance, right? You have 5 trillion in real money, and then the rest of it is just, created through credit, basically.
What's M3 then?
The Fed stopped tracking M3 back in 2006, but M3 is basically is similar to
Right before
M2,
2008. Interesting.
More larger institutional deposit, right? The Fed basically decided in 2006 that it didn't get enough insights from tracking M3, and it's expensive to track M3.
But what is it?
They stopped.
Institutional, like just major size, like bank trades, or
yeah, like institutional, deposits, large money, institutional money market funds or other assets, euro, dollars, that kind of thing, right? So these, it's not retail, right? It's more like, investment banks or like big banks and, asset managers and things like that, right? I can't tell you why they didn't find, more insights from that, and they decided to discontinue it. I'm guessing the cost to, keep it up must have been so great that they didn't, find it justifiable to keep tracking it. So,
and then M4, what do you got for M4?
I don't think M4 is real. I mean, there is technically, but we don't go that far, right? Because now you're really asking like, okay, what are other things that could be like considered money or whatever? I don't know. You go far enough, crypto somewhere in there, But usually they look at M3 or below, right? Or even like M2 or below. Usually when economists and central bankers are looking at core monetary aggregates, it goes up to M2 and M3, right? What's considered money? I mean, you look at your stock account, you look at your bond portfolio, whatever, right? To you, those are investments, right? You don't see them as money, right? So there's no need to like keep going down the up the hierarchy to like, add more things that could be considered money, right? Like just look at the core monetary aggregates and then go from there. But yeah, I guess that's a good segue to stablecoin monetary aggregates, isn't it? So,
taking that same mapping in fiat in the traditional banking system, you also lay out in your paper, in your publication, a similar style like M0, M1, M2. Can you go through that so we can kind of get a contextual mapping?
Yeah. So, I was looking at the fiat money supply diagram, and I was like, why don't we have one for stablecoins? This seems intuitive enough. Let me make one. But that's in the process of me making it, I realized something, and I was like, wait a minute. I can't make it the same way that you would do it for fiat. Dynamic is not the same. It's not the same monetary structure. That's when I realized that, fiat money is endogenous fractional reserve, but stablecoin is exogenously back, full reserve. It's a difference, right? It's like yin and yang, basically, opposite of each other. And so the dynamics actually inverted, right? The dynamics are inverse. I'll give you an example, right? Or like to be more specific about this. Credit creation or credit expansion in fiat expand the money supply. For stablecoin, credit expansion could actually reduce the money supply if there is not sufficient liquidity. When you borrow a stablecoin, what do you do with it? You sell it. Now, some people might borrow a stablecoin to like go relend it. Okay, sure. Sometime, not all the time. I mean, most of the time you can't borrow and relend it at a higher rate. You know, that don't really, I mean, sometimes it does exist, but not very, common, right? So most people, when they borrow a stable coin, they sell it or they redeem it for the underlying liquidity, right? Even if they don't redeem it and they sell it to someone else, somebody else who got the hot potato is going to go and redeem that hot potato to get the liquidity from it, right? So, ultimately, when you extend credit in an asset that is supposed to be backed by underlying liquidity, people want to get that underlying liquidity out. And so when you create credit that's denominated in that asset, it will get redeemed to get that underlying liquidity out, and that reduces the circulating supply, right?
So it reduces the circulating supply of the stablecoins. The assumption here is that stablecoin itself is money. Now, since it is stablecoin, it means it's pegged to some other asset that's considered money. Here, we're talking about mostly dollar-based stablecoins. If that's the case, then if there is this credit expansion, then yes, it is causing the redemption, and so the stablecoin supply goes down. But that's because the dollar is functioning properly as money. So if you look at stablecoins as like a subcategory on top of the regular money supply, which is endogenous and all that stuff. But if we're fulfilling a role of money velocity, then isn't it still increasing overall money supply? Just overall money supply is bigger than just the stablecoin supply.
Correct. The overall macro global money supply, yes. But when you're looking at the stablecoin money supply as a standalone by itself, right? Then what you actually see is the number of circulating tokens go down because of redemptions, because borrowers go and redeem the stablecoin which they have borrowed, so they can get what's called final settlement liquidity from underneath it, right? From the backing of it. That is, it reduces circulating supply, but also creates debt. Now, when you deposit your stablecoin into your Aave lending deposit, people are going to borrow it, right? You as a lender, yes, people borrow it. All you care about, do I get interest, right? And how much risk there is, right? You look into your Aave balance, you still see your it says, hey, I have this much amount of USDC deposited, but I just borrowed it yesterday. It's technically not there anymore, right? But you still see it as a deposit liabilities. So the stablecoin is a token liabilities, but when you put that token into lending protocol, for example, now that token, that account or that wallet, the protocol that's holding it, now is a deposit liabilities. That deposit liability, it may not be liquid today, but it may be liquid tomorrow, right? It's still a claim on the token liabilities, right? It's still a claim on the token itself, even if that token has been borrowed and then redeemed and removed from circulation. That claim still exists, right? So guess what? When the borrowers have to repay that debt, guess what the borrowers have to do? They have to buy back that stable coin or remint it, have to mint it again to pay.
The deposit liability is similar to like what the bank accounts have going on. So this is like the M1. And you're saying that the M0 disappears as people do this redemption, and so M1 actually outpaces M0 rather than being additive?
Not quite. So for stable coins, the M0 for a reserve-backed stable coin is backing, it's reserve, right? Like for USDC, it would be like bank deposit or T-bills, right? Or reverse repo instrument that's backing it. And M0 is always one-to-one to the circulating supply, token liabilities, which is M1, right? M0 and M1 for stablecoins always the same, one-to-one, right? Whereas for fiat, it's not one-to-one. M0 can be like $1 and M1 could be like $8 or $9 or $10 or something like that, right? But for stablecoin, M0 and M1 is the same. Credit, creation doesn't happen for stablecoin. Stablecoin doesn't, reserve-backed stablecoin does not have credit creation. Fiat money have credit creation, right? Because the act of creating money out of thin air and then lending it, that's creating both the money and the credit at the same time. For stablecoin, you only have money creation, right? Or token issuance, right? One-to-one, right? You need M0 one-to-one in order to issue M1, right? Now, when you put that M1 into a lending protocol, right? And then people start borrowing it. That's not credit creation. That's credit intermediation. It's a different word, right? So that's when you're matching lender and borrowers who have existing deposit, existing liquidity to lend and borrow, right? You need pre-funded credit supply in order to have credit intermediation. Whereas credit creation, you don't need existing credit supply. You just make it out of thin air, right? That's what the banks do. So for stablecoin in the M2 layer, that's where credit intermediation happens for stablecoin, right? That's when you put your stablecoins into lending deposits and then it get borrow out, right? That debt right there, that debt represent the additional, the delta between M2 and M1, right? That's the debt. M1 is just circulating stablecoin, right? But the, M2 is circulating stablecoin plus debt, plus all the debt that is, has been borrowed from all the lending protocols, right? Because that debt likely redeem those stablecoins, right? When it's been borrowed, that debt, the borrowers ultimately redeem the stablecoin, remove it from circulation. When they have to repay that debt, they have to get the stablecoin back. They have to mint it again, right? To repay the debt.
That creates a lot of buy pressure, right?
Exactly.
And then
so
the mint and the redeem and the mint and the remint.
Exactly. So credit contraction, right? When borrowers unwind debt, when credit contraction happens, that's when the money supply, the circulating supply, should I say, the circulating supply for the stablecoin re-expand. So this is the opposite effect that we have with fiat, right? In fiat, credit expansion means money creation as well, right? More credit, more money. Less credit, less money. That's how the fiat system works. In the full reserve system as a stablecoin is the inverse, right? More credit expansion, less circulating supply. Now, unless there is secondary market liquidity. This is where secondary market liquidity can help absorb selling pressure from borrowers in order to, divert redemption pressure away, right? In order to sustain the circulating supply. Because when I borrow a stablecoin, right, instead of redeeming it, if there's good liquidity on like Curve or like Coinbase or whatever, I'll just sell the stablecoin instead, which I just borrow, right? And the other person that's providing the liquidity for it, now that they got the hot potato, hey, if they're comfortable with keep providing liquidity for it, right, then they might not need to redeem it, right? So when there is liquidity provider, when there's sufficient secondary market liquidity, right, it could help absorb selling pressures from from borrowers and not, contract the circulating supply as much.
So we, as money market curators for RWAs, use this exact thing when dealing with asset issuers to model what it's like for different types of depositors. We'll have whales, sharks, and minnows. Like minnows will use the spot liquidity. If they take out a loan, they can exit. It's fine. If you have sharks coming in with decent size, they're not going to have enough capital usually in the secondary liquidity. And so now it gets to base redemptions and figuring out is it T plus 8 hours, is it T plus 1, what size they can do. And then whales are not going to have even immediate redemption access in the first T plus 1 or so. So it's structuring how long can they do it. In traditional markets, it might be rolling 90-day windows, which BlackRock just froze redemptions. So totally agree. I mean, the Curve had fantastic innovations around how stable liquidity pools should be different than Uniswap V2, which was popularized at the time with full scale liquidity. It's we don't need liquidity at 20 cents. We need really tight liquidity here. But that's still in real business only deals for the minnows, because redemptions and liquidations without fees are going to be so much more preferable than fat slippage on something that you could wait 8 hours for.
Exactly. And I think with, the way that stablecoins are going to become more and more prevalent in institutional finance and capital markets, these T plus, 1, T plus 2 or 3 eventually is all going to go away with tokenized equities and tokenized, real world assets too. Everything gets on chain. We have, settlement win time and, decreases significantly. Everything is just going to be T plus 0 in the future. Hopefully that's the, direction we're going toward, right?
Exactly.
I liked in your paper, you went in depth on M2 to M0 in traditional finance having a 4.2x multiplier, which shows basically the state of leverage in global economy, or at least American economy. But then in crypto, it's currently 1.13x. Where do you think that number gets to?
Yeah. Okay. So I guess some more context on that. So as you know, with fiat money, credit creation is money creation, right? So the money supply can multiply, very quickly, right? And I think the multiplier, the M2 to M1, M2 to M0 multiplier right now for fiat money, for the US dollar specifically, is 4.21x. Meaning every dollar of base money creates an additional $3.21 of money supply from debt creation, right? For stablecoin, it's different. It's a lot lower, right? So for stablecoin, you have to take M2 divided by M1, which is the all the stablecoin deposit liabilities and debt plus circulating supply divided by circulating supply, right? So here you have 1.13x, right, which is what I've calculated, and so that implies that every $1 of stablecoin, of circulating stablecoin, creates an additional 13 cents in debt and utilize deposit liabilities, right? So it's significantly lower than fiat, right? And you might think that you might say, oh, of course, because this is full reserve, narrow banking like, right? So leverage and credit expansion is limited. That's obviously what's happening here. Yes, to partially, right? I think what's also the main driver of this low multiplier is because simply stablecoin credit markets is so immature. It's only 2026. Come on. Like, you look at all the stablecoin loans outstanding right now on Aave, probably not even $10 billion, I would say, right? Like maybe around 10 billion, maybe 12, I would say maybe less than 15 billion. I have to go double check my numbers, right? But that's nothing. That's nothing compared to the global credit market itself, which is like 40-50 trillion dollar in total, right? So it's just a tiny speck of sand in the grand scheme of things. Now, when stablecoin credit markets evolve and mature some more, you will see a higher money multiplier for
Are we going to see 4? Is it going to be locked around 1.5 to 2? Are we going to get higher than traditional markets? Is actual M2 over M0 going to get to 5 or 6 before things blow up?
Here's a new one. We might be able to get to the same 4.2 as, or around 4x or 3x or 5x or whatever, right? Versus fiat money. But what you have to understand is in fiat money, that multiplier, it increases progressively, right? For stablecoin, it increases regressively because you start out, okay, over here with fiat, you have $1, right? And you create more loans from it. And now you have $10. The money supply expand, right? For stablecoin, let's say I have $10. I lend it out, I lend out $9. $9 gets redeemed, right? Or now I have one token in circulation, right? But if I count all the utilized deposit liabilities, it's still $10 worth of that plus the circulating supply, right? It's still 10, but 10 divided by 1, it's 10x, right? How am I able? It's still it's still a large multiplier, it's still 10x, right? But it has done so regressively. It shrank. It wasn't because it grew. It shrank, right? The circulating supply shrank versus the debt. So that's why you have a higher multiplier, right? So the multiplier here itself, it's not like, just looking at the money supply multiplier for the stablecoin, the core stablecoin aggregate itself, I don't think it's the full picture. You have to factor into DeFi composability, right? Because when you create a stablecoin, or when you have stablecoin lending deposit, those things could be wrapped, right, into other stablecoins or other derivative and assets, or those deposits themselves have a receipt tokens. Guess what? Receipt tokens are they are derivatives, right? Just as M0 reserve, fully back M1, right? Well, all this M1 and M2, when you create a receipt token from it, it becomes the meta M0 for these new receipt tokens, if you know what I mean, right? So now you have what's called the meta money supply. All these receipts, all these composable derivatives that grows on top of the base token liabilities and deposit liabilities layer, additional claim layer liabilities and claims on top of each other, right? That right there, if you look at that and you tally up the full multiplier for the money supply, is way bigger than 1.13. Like for example, USDC or USDT, right? If you look at, how much USDC in circulation versus how much USDC loans there are, there's way more in circulation versus loan. But if you think about, okay, how many other products have incorporated USDC, has wrapped USDC or collateralized USDC, as part of their own composable like stack, right? When you count all of that in, now it becomes, even greater than, potentially greater than the USDC circulating supply itself. Maybe not, who knows, right? Like, I mean, again, it's still very early right now. That's part of my next research, right? I got to go get all the data and build a dashboard and trying to figure out, like, the full extent of, like the money hierarchy, right? Like the money view, right? The money view of the stablecoin ecosystem. So, but yeah, it's the meta money supply that's gonna be, I think, very interesting for policymakers, for central bankers, or like for even builders and investors, anyone to look at in the future, because they have to understand that it adds more complexity, it adds more systematic risk, it adds more potential for things to go wrong. It's exciting, it's opportunities and blah blah blah, yield and all that, right? But at the same time, there's risk. That shouldn't be overlooked, right? Especially when everything is so interconnected together. One thing blow ups, downstream, it can have, it can propagate very rapidly back upstream and just blow up everything, right? So you have to be very careful.
Downstream, upstream, it'll blow upstream. We get it.
There we go.
Aligned that these, staggered claims on redemptions going up is how credit expands, and that as crypto gets more capable of readily explaining and documenting and having, if agents are the ones that are doing the bulk of transactions, building in skills for their own understanding of taxonomies to understand what kinds of stables they should accept, how they do commerce with each other, it will lead to higher velocity if we're able to properly devise this taxonomy, get it easy to understand, and get it really, really well documented so we understand, everyone can have their own risk assessment and deal with whatever money they're willing to. A little bit of extra context for a story I'll say for our audience around how these kind of claims on debts work is like, if you see hey, the Lakers got bought for $10 billion, it's not cash, it's not like sent to your checking transaction, it's a major like stock and portfolio transaction where they assume other positions from the users. When Elon Musk buys Twitter for $45 billion, he's not cutting a check, it is a loan against stock, where if that was like liquidated, it'd be liquidated immediately. Like the lender would take bad debt in that. They created cash to fulfill that deal, but all it is stock. And if Elon Musk actually sold all of his, Tesla stock, he'd get maybe a couple billion out immediately. So
did you guys hear about the CEO of Plaid? What he did?
What did he
do? He took a couple $1 billion worth of Plaid stock and he went and bought a bank. His loan to value was like 5%.
Wow.
And he bought a bank for $70 million and just went all in.
Wow. That's amazing.
It's pretty wild. 70 million. When we're talking about billions of stable coins, $70 million for a bank starts to seem almost cheap in the grand scheme of things.
Yeah. I mean, in the grand scheme of things, human economy only is like, nothing. When you add in the machine economy that's going to come later, oh my God, can you only imagine what they're going to do with the stable coins? Anyway, my brain keeps drifting over to that, that exciting area now. So
it seems like it's taken a lot of your brain power to like think about the agents and the future of these stable coins. Stably's role in terms of token advisory and stablecoin advisory. What's next? What's the thing that the Stably is going to do? Any alpha leaks?
Sure. I mean, I guess as far as our business model is pretty straightforward at this point. We have clients such as large institutions that need to issue their own stablecoin. Usually they could go to another partner and white label or rent effectively the infrastructure externally to do it. But a lot of these institutions they need to worry about risk management, compliance, and a lot of other issues. So they want to look for their own proprietary stablecoin infrastructure or stablecoin engine, right? And that's where we can step in and we can, help augment their capability and provide, infrastructure that's battle tested, that's been running since 2018, right? And also along with that, we also provide strategic advisory and consulting for these institutions in order to help them navigate the space, bring the stablecoin to market, or even like developing it and piloting it. For clients that are interested in actually renting the infrastructure or just white labeling a stablecoin, not having to build their own internal system, that's fine as well, right? I mean, different shoe size for everybody, right? For those that rather just outsource that infrastructure and then just focus on the go to market and whatever, we can support with that as well, right? We have deep networks of regulated stablecoin-as-a-service issuers that could get a stablecoin out as quickly as in a week or two for the clients for a very, very low cost. And we can then come in and help provide advisory services to help the client be able to take the stablecoin to market, build liquidity for it, match the peg for it, manage risk for it, integrate with credit markets, building credit for it, all that stuff. So think of us as like a fractional stablecoin team in a way, right?
You are stablecoin doctors,
Yeah, I guess in a way.
on the job.
Either you're gonna have to hire somebody in this industry that's gonna cost a lot of money, very difficult to find, and even if you do find one, I don't know if they would have 8 years of hands-on stablecoin industry experience like the people
Nobody
here at
does,
Stable,
man.
right? So so
4 other stablecoins might.
they find value in that.
4 other stablecoins might beg to differ with you. Kory, this has been awesome. If people want to reach out to you, what's the best way to get a hold of you?
Check out our website, stably.io. You want to reach out to me. My email is Kory, Kory, at stably.io. Yeah.
Kory, thank you for the alpha.
Thank you.